Most Australians are paying more income tax than they legally need to. Not because they're doing anything wrong, not because the system is broken, because they don't know about a set of tax rules that the ATO makes available to every Australian. Rules that, when understood and applied correctly, can legally reduce your tax bill by thousands of dollars every single year. The tax-free threshold is the most well-known of these. But what most people don't realize is that the tax-free threshold is just the beginning. Stack it with the right offsets, the right deductions, and the right timing decisions, and the right total amount of income you can receive before paying a single dollar of tax is significantly higher than most Australians ever discover. Today we are going to go through exactly how the tax-free threshold works in the current financial year, what gets added on top of it, and the specific rules that are hiding thousands of dollars in legal tax savings for most Australians right now. Let's start with the foundation. The tax-free threshold in Australia is the amount of income you can earn in a financial year before you pay any income tax at all. For Australian residents, this threshold has been set at $18,200 for a number of years. It means that the first $18,200 you earn from any combination of employment income, investment income, business income, or other accessible sources attracts zero income tax. Simple so far. But here's where it gets interesting. Most Australians think of the tax-free threshold as a flat floor, $18,200. Then tax starts. What they don't realize is that the low income tax offset, commonly called LITO, sits on top of the threshold and effectively pushes the point at which you actually start paying meaningful tax considerably higher. The LITO is a tax offset, not a deduction. An offset, meaning it directly reduces the amount of tax you owe after it's been calculated. For eligible Australians, LITO effectively extends your tax-free zone beyond the base threshold. When you combine the base tax-free threshold with the full LITO, many Australians find that their effective tax-free income level is significantly above the headline $18,200 figure. And there's a second offset that stacks on top again for lower income earners, the low and middle income tax offset, known as LMITO, which has had varying application across recent financial years. Always check the ATO website for the current year's applicable offsets, because these change with federal budget announcements. But here's what most Australians don't realize about how these offsets interact with retirement income. If you are retired and receiving tax-free super income, as we've covered in earlier videos, super withdrawals after age 60 are completely tax-free. That income does not count as ASHA. Antum, på 9 notebook. Habe sold, emergency-free. It doesn't reduce your offset entitlements. It doesn't push you into a higher tax bracket. This means that a retiree who is drawing $60,000 a year from their super and also earning, say, $20,000 from part-time work or investment income may pay significantly less income tax than a working Australian earning the same total amount, purely because of how the tax treatment of different income sources interacts. Understanding this interaction is not aggressive tax planning. It's simply knowing how the system works. The next part is where most Australians get caught, and it's specifically relevant to anyone earning from multiple income sources. When you have more than one income source, a part-time job, a rental property, dividends from shares, interest from a bank account, the ATO combines all of your accessible income and applies the tax-free threshold and offsets to the total. This is fine, and it's how the system is designed to work. The trap is in tax withheld at the source. When you start a job, your employer withholds tax from your pay according to whether you'd for years claimed the tax-free threshold with them. If you have two jobs, you can only claim the threshold with one employer. The second employer withholds tax as if you're already earning above the threshold. If you don't account for this correctly, if you have multiple income sources and you haven't created and hurried in this, which one should claim the threshold and which ones shouldn't, you may either underpay tax during the year and receive a debt notice at tax time, or overpay tax all year and not claim back the overpayment until your return is lodged. Neither outcome is ideal, and both are preventable with basic awareness of the rule. The ATO's withholding declaration form, which you complete with each employer, is where you indicate whether you're claiming the threshold. If you change jobs, start a second income source, or change your circumstances during the year, updating this declaration promptly prevents the underpayment and overpayment problems. Now let's talk about deductions, because this is the area where the greatest amount of legal tax saving sits for most working and retired Australians. And it's the area most people underutilize simply because they don't know what's claimable. Deductions are expenses that reduce your assessable income before the tax rate is applied. Unlike offsets, which reduce the tax you owe, deductions reduce the income figure that tax is calculated on. This means the value of a deduction depends on your marginal tax rate. The higher your marginal rate, the more a deduction saves you. For Australians in their 50s and 60s who are still working, the most commonly underutilized deductions fall into predictable categories. Work-related expenses, clothing, tools, professional memberships, home office costs, phone and internet for work use. These are claimable to the extent they are directly related to your employment income. The ATO has specific rules around each category, and there are fixed-rate methods available. For some of them, like the revised fixed-rate method for working from home, that simplify the calculation without requiring detailed receipts for every individual expense. Investment-related expenses, interest on loans to purchase income-generating, investments, management fees, subscription costs for investment research, and the costs of managing a rental property are deductible against the income those investments generate. Australians with rental properties or share portfolios often have deductions available that they either don't claim or don't claim fully. The critical thing to understand is that deductions don't need to be large individually to matter collectively. A combination of modest deductions across work expenses, investment costs, and other eligible categories can push your taxable income meaningfully lower, and at a 32 per soul marginal rate, every $1,000 of legitimate deductions saves $320 in tax. Now for the insight that delivers the most value for Australians specifically in the context of FY27 planning. And this is the one that requires the most deliberate timing. The interaction between your deductions, your income, and the financial year end. The Australian tax year runs from the 1st of July to the 30th of June. Decisions made in the weeks before the 30th of June, on both the income side and the deduction side, can make a material difference to your tax position for the entire year. On the deduction side, prepaying eligible deductible expenses before the end of the financial year pulls the tax benefit forward into the current year rather than the next. If you have an investment loan, prepaying 12 months of interest before June 30 creates a deduction in this financial year. If you're planning to make a charitable donation, making it before June 30 rather than in July claims the deduction 1 year earlier. On the income side, particularly relevant for self-employed Australians or those with investment income, delaying the receipt of income until after July 1 pushes it into the next financial year when it becomes next year's taxable income rather than this year's. None of this is aggressive avoidance. It is timing. And timing is entirely legal, entirely within the rules, and consistently overlooked by the majority of Australian taxpayers who don't think about their tax position until they're sitting in front of their accountant in August. Let's put this together through one person's situation. Consider a woman. We'll call her Karen. She's 58. She works part-time, earning a modest income from her employment. She also has a small share portfolio paying dividends, a bank account earning interest, and she made a donation to a registered charity in April. She has work-from-home expenses she hasn't tracked. Karen lodges her tax return in July. She claims the tax-free threshold. She includes her employment income, her dividend income, and her interest income. What she doesn't do, she doesn't claim her work-from-home expenses because she didn't keep track of the hours. She doesn't claim the management fees on her share portfolio because she wasn't sure if they were deductible. She doesn't prepay anything before June 30 because it never occurred to her. Her tax return is technically accurate, but it is not optimized. A tax-aware version of Karen would have used the ATO's fixed-rate working-from-home method, which requires only a record of hours worked from home to claim a legitimate deduction without complex receipting. She would have included the investment-related expenses her portfolio generated, and the year before, she would have prepaid her investment loan interest and made her charitable donation before June 30th to pull both deductions into that year's return. None of these changes require an accountant's wizardry. They require knowing the rules exist and acting on them before June 30th, not after. Here is what you should do right now. First, check whether you have correctly nominated the tax-free threshold with your primary employer or income source. If you have multiple income sources, make sure only one is claiming the threshold and the others are withholding at the correct rate. Second, start a running record of your work-related expenses now, not at tax time. A simple spreadsheet or notes app recording hours worked from home, work-related purchases, and professional costs takes minutes to maintain and can save meaningful tax at year-end. Third, if you have investment income, rental, dividends, managed funds, speak to your accountant about which associated expenses are deductible against that income. You may be leaving legitimate deductions unclaimed. Fourth, think about your June 30 timing. Is there a deductible expense you're planning to make in the next few months that could be brought forward to before June 30? Is there investment or business income that could reasonably be delayed until after July 1? These timing decisions are most effective when made in advance, not in the last week of June, when you're rushing. Fifth, and this is the one that matters most for Australians approaching retirement, understand how your super income interacts with your tax position. If you are drawing tax-free super and also earning other assessable income, your effective tax position may be significantly better than you think. Modeling this before you make decisions about how much to work and how much to draw is what a financial planner or tax advisor does, and it's what allows you to structure your retirement income to minimize tax across the transition years. The Australian tax system is not simple, but it rewards people who understand it. The tax-free threshold, the offsets that extend it, the deductions that reduce your taxable income, and the timing decisions that optimize your position across the June 30 year-end. These are all tools that are available to every Australian taxpayer. The difference between a tax return that's accurate and a tax return that's optimized can be measured in hundreds or thousands of dollars every single year. Over a decade, that difference compounds into a number that would surprise most people. If today's video raised questions about your own tax position, your offsets, your deductions, your timing strategy, put them in the comments below. And if you want a full video dedicated to the work-from-home deductions specifically, or to the interaction between super income and the tax-free threshold in retirement, let me know which one. Your retirement deserves a compass, not guesswork.